Hello and welcome to The Explainer. Today we're going to connect some dots, between a bunch of things happening around the world that might not seem related at first. And it all leads to one really urgent question. Are we on the brink of a major liquidity crisis?
Okay, so here's how we're going to break this down. We'll start with a huge monetary policy shift happening in Japan. Then we'll see how the markets are reacting, freaking out. After that, we'll layer on the geopolitical wildcards, the stuff that makes everything more complicated. We'll ground all this with a real-world example from a local market, and then, at the very end, we'll tie it all together.
So let's start with the catalyst for all of this. Our story really begins with the Bank of Japan, where a decision is brewing that could send just massive shockwaves through the entire global financial system.
I mean, you have to wonder, right? Why is a meeting in Tokyo shaking things up on Wall Street and maybe even rattling your crypto portfolio? Well, it all comes down to a really popular, but also really risky strategy that has been quietly pumping trillions into markets around the world.
It's called the yen carry trade, and the idea is actually pretty simple. For years, investors have been borrowing Japanese yen at almost zero interest. It's basically been free money. Then they take that cash and buy other stuff that pays better, like US stocks or Bitcoin. For a long time, this has been an absolute party for investors. But that party might be about to end.
And this is where things could get really hairy. It's a chain reaction. See, when the Bank of Japan finally decides to hike interest rates, that free money isn't free anymore. All those investors have to pay back their yen loans, which are suddenly more expensive. So what do? They have to sell their other assets to raise the cash. And when everyone starts selling at the same time, global markets can fall, and fall hard. And look, this isn't just a theory. We got a little preview of this back in August when a surprise rate hike sent the Nikkei down 12% in a single day. That's what a stampede for the exits looks like.
That's why some analysts are calling this whole situation a silent time bomb. Everyone's got their eyes on the upcoming December 19th Bank of Japan meeting. It could be the event that triggers this whole unwind. Now, the weird thing is, the market seems to be betting that the Bank of Japan will just blink, that they won't act decisively. But man, that feels like a very, very risky bet to make. Please don't forget to subscribe to my channel, turn on the notification bell, share and like my videos. This is not investment advice. Thank you.
So, with that massive risk just hanging in the air, you have to ask, where is all the money flowing? Well, as this liquidity earthquake seems more and more likely, capital is running for cover. It's fleeing into tangible, safe haven assets. And what's really fascinating here is this complete split in policy. Over in the US, the Federal Reserve is cutting rates, trying to find that neutral level that doesn't slow things down too much. But at the same time, the Bank of Japan is under huge pressure to do the exact opposite. This creates a massive global tug of war for capital.
And the market's reaction has been nothing short of dramatic, especially in precious metals. Just look at silver. It's posted a staggering gain of over 122% this year alone. That's not just a correction, folks. That's a stampede into physical assets. And it's being driven by a combination of industrial demand and good old-fashioned investor fear.
And of course, this illustrates that flight to safety perfectly. While gold has been hanging around the $4,000 mark, you're now hearing analysts seriously talk about $5,000 as the next stop. In times of crisis, it's seen as the ultimate safe haven.
Okay, as if all that financial tension wasn't enough, let's go ahead and layer on something else. We've got a perfect storm of geopolitical risks brewing, and it's just adding fuel to this fire.
And these aren't just separate issues. You have direct military action messing with the oil supply, you have major saber rattling in Asia, and you still have the war in Ukraine grinding on, which is straining alliances and resources. Each one of these things creates widespread uncertainty, and that just pushes investors even more towards the safety of physical commodities.
This quote really says it all, doesn't it? The entire conversation around Venezuela has shifted. It's moved way past economic sanctions and into a direct military posture. You have U.S. forces actively stopping tankers out on the open sea. That's not just financial pressure anymore. That's a physical blockade.
Now, these huge global pressures don't just stay up at 30,000 feet. They eventually hit home. And to see how they can really distort a national economy, let's just zoom in on one specific market, Turkey.
So get this. On paper, the Turkish housing market looks like it's booming, with prices up over 30%. But, and this is a really big but, when you actually factor in inflation, homeowners have been losing real value. And this isn't just a one-off thing. This has been happening for 21 consecutive months.
So here's the crucial point. Those on-paper gains can totally mask a weak economy underneath. What looks like a profit is actually a loss in purchasing power. It's a phenomenon that could very easily play out in lots of other markets that are facing these same kinds of pressures.
All right, so we've looked at the catalyst, we've seen the market reaction, we've talked about the geopolitical factors speeding things up, and we've seen the local impact. So what does it all mean when you put it all together?
Well, each of these trends is a storm in its own right, for sure. But they aren't happening in a vacuum. A monetary policy shift in Tokyo is directly connected to the price of silver in London, which is being influenced by a naval blockade off the coast of Venezuela. They all seem to be converging into something much, much larger.
And that really is the key question we have to consider, isn't it? Are these just a few isolated storms that'll blow over, or are we actually witnessing the very beginning of a global liquidity hurricane? The answer is going to shape the entire financial landscape for 2026 and well beyond.